Under a sky of rising trade tensions and sudden tariff threats, 7 countries quietly began to tilt their trade decisions toward Canada. What started as cautious conversations and a few new orders turned into a clearer pattern. Governments and businesses abroad are looking at Canada not just as a neighbor, but as a reliable gateway for goods, energy, and investment. This script walks through why that shift is happening, who the 7 countries are, and what it means for global trade. All told in plain third-person language that a wide audience can follow. The story begins with a shock. Fresh U.S. tariffs and a sharper, more unpredictable approach to trade policy. When Washington announced new levies that hit a range of imports, trading partners around the world felt the ripple. Companies that had long leaned on predictable U.S. access suddenly faced higher costs and harder choices about where to sell, where to source, and how to protect their markets. The immediate effect was real. Importers revised plans and exporters sought safer, more stable options to keep their products moving without sudden price jumps. This move away from the U.S. marketplace, or at least the search for alternatives, set the stage for Canada to gain attention as a trading partner with fewer shocks and more steady rules. Canada's timing mattered. For years, Ottawa quietly built a network of trade agreements and partnerships that made it easier for foreign buyers to work with Canadian businesses. Canada already has a long list of trade deals that open doors to markets across the Americas, Europe, and the Indo-Pacific. That legal and commercial groundwork meant that countries looking to diversify their trade ties could often find existing pathways into Canada without long, messy negotiations. For many businesses, buying from or investing in Canada suddenly looked like the low-friction choice. Familiar legal protections, trustworthy institutions, and existing rules that supported cross-border commerce. Mexico was among the first to be noticed in headlines. On a practical level, Mexico sits next door to both Canada and the United States, and it has deep links to North American supply chains. But recent diplomatic signaling showed Mexico willing to deepen cooperation with Ottawa, at a time when tensions with Washington were on display. Canadian leaders dispatched high-level envoys to Mexico City to talk trade and investment, especially in energy and manufacturing. Moves meant to reassure businesses that Canada and Mexico could partner more closely if the U.S. became less predictable. That outreach was not just a diplomatic gesture. It was a concrete nudge for Mexican firms and foreign investors to consider Canada as an alternative route for trade and for regional diversification. Across the Atlantic, the United Kingdom quietly moved to make Canada a priority partner. Post-Brexit, Britain has been carving new trade strategies and looking for steady allies to expand markets and secure supplies. London and Ottawa agreed to set up a formal trade working group, a step that signals both governments want closer economic links on things like digital trade, critical minerals, and industrial cooperation. For British firms that depended on smooth relationships with allies, Canada offered a friendly and familiar legal culture, plus strong protections for investors and a willingness to coordinate on shared economic goals. That made Canada an attractive complement, and sometimes an alternative, to traditional US-centric trade routes. Japan and a cluster of Indo-Pacific countries also began to look at Canada with fresh eyes. Ottawa ramped up diplomacy in the region, sending its ministers to talk trade, defense, and investment with long-standing partners. Japan, for instance, already ranks as one of Canada's bigger economic partners in the Indo-Pacific, and both sides have been exploring deeper ties around critical minerals, clean energy, and technology. As global manufacturers hunt for reliable supplies of minerals and energy that support electric vehicles, batteries, and renewable power, Canada's resource wealth and political stability make it a tempting partner. Those conversations, backed by ministerial visits and trade missions, signaled to business leaders across Asia that Canada was serious about expanding its role, and that made it a more attractive trade counterpart. India's interest in Canada grew for a mix of economic and strategic reasons. New rounds of trade talks and gradual thawing of diplomatic friction opened the door for deeper commercial ties. Indian buyers and investors were already looking to diversify away from markets that had become more volatile or politically charged. Canada's strengths in minerals, agri-foods, education, and services offered Indian companies an alternative pathway for imports and investment. At the same time, India's own push to sign new trade deals and strengthen global supply links made Canada a natural partner. While the U.S. remained a huge market for India, Ottawa's steady trade policy and willingness to restart talks made Canada a rising option for long-term contracts and partnership deals. South Korea and several members of the Pacific Trade Group, that includes places like Vietnam and Japan, have also shown signs of tilting toward Canada. South Korea already has a deep trade relationship with Canada under a bilateral free trade agreement, and businesses there have long valued Canada's stable rules and market access. For several Southeast Asian nations, membership in regional trade pacts and the lure of Canadian raw materials and clean energy made economic sense. Manufacturers in the region that need secure supplies of copper, nickel, and other minerals for electric vehicles and electronics began eyeing Canadian suppliers as they plan multi-year contracts. Over time, such procurement choices add up, slowly redirecting some flows of trade away from U.S. sources and toward reliable partners like Canada. Why do these 7 countries, Mexico, the United Kingdom, Japan, India, South Korea, Malaysia, and Vietnam, find Canada so appealing at the moment? There are several overlapping reasons, and together they help explain a larger pattern. First is predictability. Canada's laws and trade practices are seen as stable and transparent, which matters deeply when businesses sign contracts that will take years to pay off. Second is resources. Canada is rich in energy, timber, agri-food, and especially in critical minerals that power new technology. Countries that need those inputs for clean tech or manufacturing see Canada as a secure supplier. Third is diplomatic balance. When the U.S. adopts aggressive tariff moves, countries look for alternatives that won't expose them to sudden political risk. Canada's active diplomacy and the dense web of trade agreements make it a sensible choice. Finally, Canada's services exports, digital and professional services, are growing fast, offering new kinds of trade that go beyond raw goods. Business leaders are responding to these factors in practical ways. Procurement teams in multinational companies reroute orders, sometimes testing Canada as a supply base for a single product line before committing more. Investors are watching pension funds and sovereign wealth money moving toward Canadian assets. Those big pools of capital can make long-term deals more attractive. Meanwhile, small and medium-sized exporters in Canada are learning how to sell into markets they once ignored, thanks to trade missions and government programs that reduce the cost of finding foreign buyers. All this creates a feedback loop. More trade and investment means more experience, which lowers transaction costs and encourages still more commerce. Not every company or country will abandon the U.S., and the reality is nuanced. The United States remains the world's largest market and a near-automatic destination for many supply chains. But what changed was risk math. When a single tariff decision can raise costs by double digits overnight, firms start treating diversification not as optional, but as insurance. In that sense, Canada's rising role is less about outright replacement and more about being a second, stronger option when the U.S. becomes uncertain. Firms hedge by splitting suppliers and expanding exports to Canada or through Canadian partners who can move goods into global supply chains. This kind of hedging is exactly what many decision makers say they want in a world that now feels a little less predictable. There are specific sectors where Canada's appeal has been strongest. Energy and natural resources top the list. NATO-aligned countries that want secure, long-term energy ties see Canada as less risky than suppliers with geopolitical entanglements. Critical minerals, lithium, nickel, cobalt, copper, are another hotspot. Canada's geology and mining industry make it a prime source for inputs that feed batteries and power grids. Agri-food is a third area. Canadian wheat, pulses, meat, and dairy often carry trusted sanitary standards that foreign buyers prefer. Finally, digital and professional services, everything from cloud-based software to engineering consulting, are growing fast in Canada and open up new trade lanes. Buyers who once imported those services from the U.S. are now comfortable contracting with Canadian firms that offer similar quality and legal protections. But the shift comes with wrinkles and limits. Logistics remain a real cost. Shipping goods across oceans or retooling supply chains takes time and money. Tariffs can push buyers to new suppliers, but switching vendors is not instant. Regulatory alignment matters too. Buyers wish to avoid non-tariff barriers that emerge when rules differ. Political relations can shift, and no country wants to over-concentrate on a single partner. Canada's capacity to absorb dramatic surges in demand, whether for minerals or agri-products, also has physical limits. Policymakers in Ottawa are aware of these realities and are trying to accelerate infrastructure projects, streamline approvals, and increase export promotion to handle a potential wave of interest. The big question is whether this trend will last. Much depends on politics in Washington and economic choices in capitals around the world. If the US returns to a calmer trade posture, some of the urgency to shift could ease. Companies that value proximity and scale might rebalance toward the US again. But if tariffs and trade unpredictability persist, the new connections with Canada can harden into lasting trade relationships. Long-term deals, joint ventures, and deep procurement contracts take years to build and do not dissolve overnight. In other words, the choice to work with Canada now can become a permanent part of the global trade map. Analysts and governments on both sides of the world watch this carefully, because once supply chains change, they rarely revert entirely. For consumers, the impact can be subtle, but real. Some goods may become slightly pricier if tariffs push sourcing away from the cheapest supplier. In other cases, having multiple supply lanes can stabilize prices and avoid shortages when a single supplier faces a shock. For workers and firms in Canada, the opportunity is clear: more exports, more foreign investment, and new jobs in mining, manufacturing, logistics, and services. For U.S. firms, the rise of Canada as an alternative partner means increased competition and the need to reassure clients and suppliers that doing business with the U.S. remains the smart, reliable choice. That dynamic will play out in boardrooms and capitals over the coming months and years. Ultimately, the seven-country tilt toward Canada signals a larger shift in global trade behavior. Countries and companies are prioritizing predictability, diversification, and secure inputs over single market dependence. Canada benefits from existing trade deals, diplomatic outreach, and a resource base that the new green transition demands. But Canada's challenge will be to scale up infrastructure, streamline trade logistics, and maintain political openness so that these new relationships can flourish without hitting bottlenecks. If Ottawa moves quickly and wisely, these seven countries may only be the first wave of partners who find Canada the easier, safer choice in a more uncertain world. The final image is not one of dramatic winners and losers, but of a more networked world where trade flows are rebalanced, not reborn. The US will remain central to global commerce, but Canada's moment shows that middle powers with stable policies and smart diplomacy can become essential nodes in the world economy. As businesses and governments adjust to new risk calculations, the map of trade may look different 5 years from now. And for some countries, Canada may have already become the partner they prefer when they want certainty, safety, and steady rules in their trade deals.